I always explain why I brought a particular question. This question, I brought it because of one, that, and two, that. This question basically, in terms of mergers and acquisition topic, it deals with the concept of consideration. We know that we have dealt with consideration, and you know the types of consideration methods or forms that are there. And the many students are now familiar with where we are coming from. The concept of maximum acquisition premium. I'm sure even in our group, you have come to understand that concept. But the concept which seems to be elusive, I think, which many students, when a question comes, they are so much defeated, is consideration. Now we know that the consideration or payment method, we can either go for cash, or we can go for share exchange. Or we can go for a combination. So if I ask you, what are the advantages and disadvantages of a pure cash payment? I'm sure from your notes, you remember that you can say something. What are the advantages and disadvantages of a share for share exchange? I'm sure you can say something. And also even a combination. So don't lose track of the fact that a question on the advantages and disadvantages of various payment methods can come either as a theory question or as a computation. So now I take it that we have done some work. We have done some work. So therefore, the first part of the question is calculate the PE ratios of TD and company implied by the terms of L company's initial and proposed offers for all three of the above options. Okay. Calculate PE's ratios, PE ratio of TD implied by the terms of L's initial and proposed offers for all three of the above options. So the question really here is calculate PE. So what do we do? Show the examiner that you know how to calculate the PE. So what is the formula for the PE? Divided by what? EPS. So just say share price and EPS implied by the terms of the company's initial and proposed offers. 5 marks. They want us to calculate the PE ratio, and the PE ratio is what we have there. So do not be scared. The first item is simply a PE ratio of T. What's the PE ratio for T? Okay. Let's find our answer. Let's find our answer. So the major item that we needed there was, first of all, to calculate the PE ratio. So let's go. So the information is here. I hope we can all see my information there. Louid initial bid is 5 shares in L for 3 shares in T. So going by this, what PE ratio are we putting on T? So what should we do first? We are offering, how many shares are we offering them? Let's go. Who has identified the number of shares? We are offering them how many shares? 5. For how many? For 3. The question is, what is the value of these shares? These 5 shares, what is their value? You go back and you ask yourself, what's the share price of this company? Now let us go. This now takes you back to valuations. This takes you back to valuation. So let us look at it from the information given. Look at the information given on L. What information have they given us? They've given you what? Now, this was the difficult part of the question. They're giving you a PE ratio of 14. What else have they given you? They're giving you what? Profit after tax. Profit after tax, what else have they given you? The number of what? The number of shares. So you can say the value of equity, I can calculate it. The value of equity is what? Multiplied by, even as you are reading the question, you should have realized that here we want the market value of shares of L, and you're supposed to use a PE valuation because the PE is given. This is the 296. That is the 14. To find per share, you divide by what? 340. So what was the trick here? The trick was, first of all, finding the share price in L. Find the share price in L. That's the first item. And then we proceed. So if that is okay, the clue was this is an asset-based valuation. So you needed the PE ratio, the formula, and also how to find the share price of it. If we have bought into that, let us now go. This is the first phase. It's only 5 marks. Fortunately or unfortunately, it's only 5 marks. So this question looks complicated. I want you to get to see how you can dismantle it. So one thing that you can tell the examiner is say, I know the PE ratio. My PE ratio is here. That's my PE ratio. Then the questioner said they want a PE ratio for the initial bid, for option number 1, option number 2, option number 3. Okay, so we can put these in advance in terms of the format. For the initial bid, then for option number 1, for option number 2, and for option number 3. So to me, you know, in an exam, I feel for you students, this can be quite complicated. You can be unsettled. But how can you get your ground or get yourself organized? Put down a formula and understand the options you're looking for. The initial bid was every 5 for 3. What of option number 1? The option number 1 is this one, to accept 2 shares for 1 share, Option number 2 is accept cash offer. Option number 3, 60% investors get 2 shares and 40% get cash offer. In other words, 60% go there, 40% go there. It's like this one is in between these two. So you show the examiner that I know the 3 options are here before I fill in the numbers. To fill in the numbers, what do you need? You need your share price divided by the EPS. Let's go for the initial bid. Let's go. We'll come down here. Okay. So we need some workings. We want to find the current share price for L. What's the first thing? You come here. Say my value of equity equals PE multiplied by the PAT. The PAT. The PE is the one that I showed you. The PAT is the one that I showed you. The value of equity, so you multiply these two to find the value of equity. You multiply that and that, find the value of equity. So the value of equity equals, let's go, 14 by 296. And this is the number of shares. So 4140 divided by 340. That's your share price, a single share in L. Please, if you are behind, you stop me so that I explain to you. So this, that divided by this. So this is our share price. So the current share price is 12.19. Please, if you are behind on any figure, let me know. The 14 is the price earnings ratio. The 296 is the PAT. When you multiply this by that, or as shown here, we get the value of equity. Divide by the number of shares, you get the share price. So the bidding company, their share price is 12.19. Now let's go to our initial bid. The initial bid is here. How many shares were we offering them? How many shares? We offered T 5 shares. Let's go. We offered them 5 shares that we're going to give 5 of our shares. So multiply like this, find the value of 5 shares. For 3 of their shares. So we are telling them that we'll buy each one of your shares. These 3 shares is this divided by 3. So we have valued their shares at 20.31. Are we together? So each one of these shares, the 3 shares that we are buying, we are giving the value of 20.31. So we've got, remember, you are calculating this. So you found the share price then. That is implied by the offer. What is the earnings per share? Company T, their profit after tax is what? The number of shares is what? So we divide that by that, get 1.42. So the earnings per share is 1.42. The share price is 20.31. So the price earnings ratio is that divided by that, or 14.28. So this was the first answer. The price earnings ratio implied by this offer is 14.28. How is that? Okay. Let's go to the next one. Option number 1. The revised option number one, how does it look? The revised option number one, how does it look? Let's go. To accept 2 shares for 1 share of. So we'll be giving them 2 shares, right? And our shares, what's the price of our shares? We are L, eh? What's the price of our shares? Let's go. Our price of shares is what? 4.19. So we are saying that then each one of their shares is 2 multiplied by 4.19. So this is the price. For every one of their shares, we're giving them how many shares? 2. So those 2 shares are carrying a value of 24.38. The earnings per share is not changing. So the PE is 24.38 divided by that. You get your answer here. What of option number 2? Option number 2. To accept the cash offer for all Tiden Company shares. Okay. Or a cash alternative of 22.75 per Tiden Company share. So here now is 22.75. That's the cash offer. We're not giving them shares anymore. So for each share, 22.75. That's a share price. The EPS is still the same. So that divided by that, this offer implies PE of 16. What of the next one? What do you do? This is a very common question, and I call it a mechanical question. What you do here is the share price, the value of the shares, you just take the proportion. You take 60% of 24.38, which is this one, plus 40% of 22.75, which is this one. So just take 60% here and 40% there. That will give the share price here. Earnings per share is still the same. The PE ratio is there. Let us pause at this point. Let's pause at this point. Have you seen how the PE has been calculated? The PE being implied by the offers. Each offer is implying a particular PE. Let me have your reactions. You are too quiet today.
Yeah. Mr. Perry.
Yes, please.
Well, I did attempt to do the question earlier.
Okay.
Seemingly arriving at the same answers, but different approach, though.
Okay, okay. Did you have the formulas? The formulas? Do you have the formula for PE? This one?
Yes, I was applying the same principle.
Yes, okay.
Except maybe my method was a bit longer. Where you first have to establish the number of shares that are going to be offered in total.
I hear you. I hear you.
Yeah. Now I realize maybe that method may be time wasting in the exam.
It will take, but it helps you to understand this. I'm sure this is much easier for you.
Yeah, somehow.
Yes.
Yes.
I'm happy you went that route. I'm very happy. You know, this question, if it comes and you haven't gone through it, it can take you in circles, eh?
Yeah, it took me hours.
It can. No, you can spend the whole time just doing this 5 mark. Now, this 5 mark shows that there's a shortcut. That's what it shows.
Okay. Yeah, sure.
I like it. I like that approach because you now, this one is so straightforward for you. Yeah. Please find time to go through this question again. If you haven't gone through how to calculate the PE from the offer that is being made, that can be a bit challenging. Eh? Good. Now, if we ask you this question, comment on the impact on L, EPS, and gearing for each of these three options. Without numbers, a number of us can comment, or we can actually try to assess what is likely to happen. Now, in this particular one, the examiner wanted you to calculate and comment on the funding required, one, and the impact on the EPS, gearing of three options given above. Now, again, I would go for a format here. I would encourage you to go for a format, meaning you ask yourself, what do I need for an EPS? Calculate EPS, what do we need? Profit after tax divided by the number of shares. So put a small table, put a small little table in Excel to show that. Put a small table to show the examiner that. So your table is here. You tell the examiner, Mr. Examiner, my earnings per share is P80 over number of shares. I've got my three options here. So before I put in even these figures here, we can blank them first. Before I put there, I have my option, I have my format here. And this is my format. I'll look for profit after tax, I'll look for number of shares, then EPS. Let there be, some structure to your answer, So even if somebody, imagine the worst case scenario, you didn't even finish this, But when the marker finds this and arranged, certainly there will be temptation to give you something. Or if some information is easier, you can put in information which is easy. Then there we say, okay, we need the working for profit after tax. So our profit after tax will come there. Okay. Then from there, profit after tax, we also need some shares. Number of shares. We need that. Again, on gearing, you tell yourself that for gearing, I need what? Value of debt and value of equity. Value of equity is my share price divided by my shares multiplied by the share price. Debt is also given there. So now let's go step by step. First of all, let us start with the additional funding. Which option will require additional funding? In a share exchange, is there additional funding required? The answer is no. So in option number one, what of option number two? Option number two, you are going to pay. What are you going to pay? Let's go. Option number two. The option number two is here. 22.75 shares. That's the cash you're going to give to give them. How many shares? How many shares are there? Let's come here. There are 90 million shares. So 90 million shares here. That's the number of shares that you have. Multiplied by 22.75. How much money do we need? Calculators, guys. 22 multiplied by 90 million. How much is that?
I'm getting 2047.5.
Multiplied by 90, okay. 207, okay, fine, that's okay. Then how much money do we have already? Let us look at how much you have already. Let us see how much money we have already. We have got some money already from the two balance sheets. Cash and cash equivalent. Now it's here. Assume also that any debt funding needed to complete the acquisition will be reduced instantly by the balances of cash and cash equivalents held by L&T. So we already have a 220 here and a 64. So we've got 284. So let's come here now. Let's look at additional funding. So let's go. 90 multiplied by 22.78, 2048. Available funds, 284. So the shortfall, additional funds required is 1764. So these are the additional funds that we need. That less what we already have. So this represents the date. That represents the date finance that you're going to raise.
Mr. Piri, can you please explain what the note that you just read said? Because to me, I think I would have reduced by the current liabilities that are there in the balance sheet as well.
Okay. I'm happy now people are talking, you know. I'm now happy people are now talking, meaning that you have read the question and you have understood the question. This is very interesting. Let's go. Assume that any debt funding needed to complete the acquisition will be reduced instantly by the balances of cash and cash equivalents. And the cash and cash equivalents are here, which is this one and that one.
Okay, I think I had not understood that comment.
Well, that's quite fair. That's a fair comment there. Okay. So the debt finance is only 1764. What will be in option 3? How many shareholders will accept cash? 40%. How many shareholders are going to accept cash? Answer, only 40%. So you take this same figure that we had earlier on and just take 40% of that. So the amount required is 819. Less that. So this is the amount that is going to come via debt. That's the amount which is going to come via debt finance. Is that okay? So this is the answer that we are looking for. That one and that one. Okay. So when you raise this money, what happens? We'll be paying interest. We have to pay interest on this amount of money. If that is okay, let us now go back and say, okay, fine, that we have seen. Your profit after tax, we have been given the current figures, the profit after tax here. For L, let's pick the figure. Profit after tax, 296. There, 128. What do you want to calculate? We want to calculate now impact on the earnings per share. So we go by, let's go. Okay, let's move this a little bit. Let's move this a little bit. 296.40 there. Okay. Synergy. Did you all see the synergy? Now you remember the concept of synergy very well, eh? They have told us that there's going to be synergy, isn't it? Yeah, they've told us synergy, that when these two companies combine, what happens? There's going to be synergy. Synergy of how much? Let's pick the synergy together. Let's pick the synergy together. L Finance Director has estimated that the major will produce annual post-tax synergies of 20 million. 20 million. So let us bring in our synergy. 20 million. Let's bring in our synergy of 20 million. Here. Net of tax interest. Now we need to remove the interest. There's going to be additional interest here and there. There's going to be additional interest there and there arising from the loans. So let's follow through. Number one. Let's go. This is our first loan. I'm sure you remember this loan, eh? Now some of you say, wait a minute, Mr. P, where are the interest rates coming from? Not a problem. Let's pick them. Assume that L can obtain further debt finance at 7.5%. And the return on cash surplus is 5%. So this company was earning 5%. So there's an opportunity cost here. And there's the interest on the new funds. How do you incorporate that? Let's incorporate it. So 7.64 multiplied by that, that's the interest. Here, 535 multiplied by that's the interest. Then there's the opportunity cost. There is the opportunity cost. These funds, 284, we are losing out. And this one we're losing out. So now, this is the interest that we have. So that plus that, that plus that. But we need to bring them in net of tax because profit after tax. So we multiply this by 0.8. Are we together? These figures, when we load them, we're going to load them this plus that multiplied by 0.8. This plus that multiplied by 0.8. Why? We have said this is net of tax interest because these figures are already after tax. Is that okay, people? There we are. So I add this plus that multiplied by 0.8. This plus that multiplied by 0.8. These are the figures you have here. So people, now you have got your adjusted PAT. Adjusted PAT or revised PAT. Where do we take this? We already have our format here. We already have our format. Number of shares. Number of shares. Number of shares, it's here. Remember, L, I've got 340 shares. Right? Here, option 1, How many shares are they issuing? Who remembers the term? 2 for every 1 here. 2 for 1. So we'll be issuing 2 for every 1. And how many shares do we have currently in here? We've got 90. So 2 for every 1. So 90 multiplied by 2. That is why the number of new shares is what? The number of new shares that we have now is 180. Where is 180 coming from? 2 multiplied by 90. Here it's a cash offer, so there's no new shares. What of here? What's the proportion? Percentage again? 60%. 60%. So just take 60% of that. That's what you put here. So this is the number of new shares. This is the adjusted number or revised number of shares. Revised number of shares. That's revised number of shares. That's a revised number of shares. So this revised number of shares is what we bring here. So the earnings per share now is here. You have your earnings per share. So this is what the question was looking for. So they wanted us to calculate the EPS. So this is your EPS here. We got adjusted PAT and revised the number of shares. Questions? So we know that when you issue shares, what happens? Have you seen what happens to our EPS? Our EPS is low here because we issued the number of shares. We got more shares there. What of here? We have got the best EPS. Why? We didn't issue shares. What of here? Here we are saying that somewhere in between there. That's what we have. The point we're learning here is one of the methods, one of the things that we do to check the consideration that we're using is the impact on EPS. How does a particular method affect the EPS? So I've seen that the use of shares is like to do what? To dilute the EPS. I hope this is a point which is quite common on consideration. What's the impact of each consideration method? The use of shares, we can see that it dilutes the EPS. The use of cash does not. But the use of cash has got a catch. Why is the catch? Why is the catch? Financial risk. Because we need to borrow. So when we borrow, that is going to create financial risk. And that is why the question says, let's calculate the gearing. So let's conclude, guys, by looking at the gearing. Let's conclude by looking at the gearing. Again, tell the examiner that I know how to calculate my gearing. My gearing is debt over debt plus equity. Where is your debt? Where is your debt? This is the current debt, 540, that L is carrying. This is the date which T is carrying 193. But remember, there's new date 764 and 535. Remember the new date? Huh? Remember the new date? That's a new date. That one. So revise the date. Revise the date. Okay, what of equity? Equity, the number of new shares, we have them. 520 here, 340 there, 448. These. So we already have the workings. The share price is here. You multiply, you've got the values of equity. Revised. Values of equity. Revised value of shares. That's what you have. So you've got your equity here. You've got debt here. So simply divide. If you do debt to equity, use that ratio, you get that. If you do debt plus equity, you get that. Let's look at the impact. Could somebody please explain to us the impact? Can somebody explain to us what's the impact of the various consideration methods? Can somebody please comment on this? I'm waiting for your comments. What comment can we make?
Oh yeah.
So I could mention.
Code for me the reset that. Which one?
Okay, so for me, what I could comment on is that in option 2, because of the new debt, the gearing ratio is quite high, which might lead to the debt, the banks, I'll put it as banks, but there's a nicer word for it, which might lead to the banks viewing us as having a high financial risk because of the high debt ratio.
We know that in theory you can be asked to comment on the impact of various considerations. So if you're going to use cash, most time and again you need to borrow the cash. And once you borrow the cash, what happens? It pushes up your financial risk, like we have seen. The lowest financial risk is where we use what? A share for share exchange. The highest is where we raise the debt. And in between, we've got the mix, which is this 19. This question, calculating EPS on this paper, estimating EPS, revised EPS, and also the gearing ratios is a question that has come a number of times. That and that. So this is something that has come a number of times. You must quickly put up a table to calculate your EPS and your gearing. So I hope that this question has benefited us in the calculation of PE or in interpreting the implication of the payment method. Yeah. Good. Where to from here? One of you was asking, send me a text, when are you starting financial risk? The good news is that we are starting financial risk in the next class. So in the next class, we're starting financial risk. What I'm going to do, I'm going to send you recordings in advance so that you can go through. What you do, I'm going to send you recordings so that you can go through in advance on financial risk. So that when you come to class like this, you would have run through already the recordings. All right, so we see you Thursday, people, same time, Thursday, same time, right?
Thank you, Mr. Piri. Thank you.
All right.
Thank you, Mr.
Thank you. Good night.